Hi, very good afternoon, viewers. Wish everyone a very warm and happy Diwali. Today is a Diwali special interview with none other than Mr. Ashish Ranawade. He is head of products and strategy at Emkay Wealth. Welcome, Ashish.
Thank you, Khoobi.
So we all will be smiling a little bit more today, the way the markets have moved. And my first question revolving around the market outlook in general. So we've seen rally since March. We're seeing a lot of yo-yoing happening in the market, but we believe that the long story is still intact. Your views, on this resistance that we see in the market currently.
So, we believe that fundamentally the markets are strong, and there is no downside to the market at this point in time because they are supported by fundamentals. Whether the markets will rally further from here, I think a lot will depend on external factors like what's happening globally, and also there are elections coming around, and there are two wars which are going on globally, and a lot of volatility can be there in the market because of these factors. But fundamentally we believe that India is on a very good growth path. We are the largest, or rather we are the fastest growing economy. We have reached a certain size now. We are the fifth largest economy in the world. So all of these factors point in the direction of a good stable growth as far as India is concerned. And from a valuation perspective, I would say markets at this point in time are a little expensive, but we have close to 3,000 listed companies, and the NSE emerge platform and the SME segment, there are a lot of companies which are listing there and presenting an opportunity for investors to invest in some of the smaller investment opportunities. And I think there is a lot of excitement there happening. At the same time, there's a lot of risk there. But if you scratch the surface and go beyond the top 500 companies, there are plenty of opportunities and plenty of companies which are still trading at attractive valuations. So my sense is, if the market does not move beyond, say, 20,000 Nifty, you will always find opportunities below the top 500, and create a portfolio, from an equity markets perspective.
Sure. I think that's also visible in the money that flows into SIP, and a big chunk of it, as we saw, flowing into small and mid segments. So I guess, investors are ready to consider what you just said, scratching beyond the top companies. Ashish, my next question, since we know that India is ready to take on this challenge in being one of the top economies, or in global investment destination, now where should the investors look in terms of the product segment, or the most promising product segment?
So I would break that into the three different asset classes that we have today: equities, fixed income, and gold, and alternative asset classes. So within equities, there are a lot of boutique fund managers, boutique PMSs who are trying to create differentiated portfolios, who are trying to create concentrated portfolios. I think that is where there is opportunity, because a lot of the money which is coming in through the SIPs and the newer investors is predominantly going into the mutual funds who are largely focused on the top 500 stocks. And so within equity, as we say, the below 500 opportunity is very well captured by some of these boutique players. And PMS is a category, I think they would score over the mutual funds if the market continues the way it is today. The second is the alternative investment funds. Again, a new category of asset class has been created within fixed income, which earlier belonged to the mutual funds, which is the credit opportunities.
Right.
which has now moved to the AIF platform. And there are a lot of credit opportunity funds which are coming up, and each one is different. There are some who are focusing on real estate, there are some who are focusing on manufacturing, there are some who are focusing on special opportunities, and there are some who are creating a basket of all three. So I think again, AIFs are very differentiated from mutual funds. They are focusing only on a few investments, and they're not looking at very large corpuses. So for investors, again, that's a very interesting segment that one can look at from an asset allocation point of view. And the third is long short funds. Now, long short funds have a unique ability that, if the market's not going anywhere, or the market's not going to give you spectacular returns, there are always opportunity to short some stocks and go long on some stocks. And I think that's an area where these long short funds score very well. So in a sideways trending market, that's an opportunity which can be looked at. And the third one I'm a very big fan of is the US markets, because there are many stocks in the US which have been beaten down with the Fed hiking rates very aggressively. And unfortunately for us as Indian investors, the route to investing in the US markets is not very easy, because either you go through LRS or you go through mutual funds, which are kind of capped in terms of their ability to invest overseas. And the third part is that the taxation on mutual funds in India is like your marginal rate of taxation. So it could be, for HNI investors, it could be as high as 38%. So I think that is a bit of a challenge, but from a pure investment opportunity point of view, I think the US markets equity markets offers you the best value at this point in time.
Got it. Ashish, you did briefly mention about fixed income and gold. So maybe if you could give more insight on your forecast on GSEC yields. And I think we came very close to the March interview that was given to Business Standard. So yeah, your take for our investors.
So yields on GSEC, I think will stay elevated for maybe another 6 months, because we don't see the Fed acting, although the number which came on inflation in the US last evening was very positive. We don't see the Fed immediately reacting to that. So I think there's some time away. That's one. And second is the yield curve is quite flat at this point in time. So given that, the movement should ideally be more on the shorter end rather than on the longer end at this point in time. And once that movement on the shorter end happens, then we will start seeing a normal yield curve, and then you will start seeing a shifting of the yield curve downward. So I think it's still about 6 months away, in playing duration. But then investors can always do an SIP. And between now and 6 months, or between now and 1 year, and invest in a long duration GSEC fund in a systematic manner. I think that kind of a strategy would play out very well in the longer term. On gold, we believe gold will continue to perform better than fixed income. That's number one. Gold has a fantastic tax arbitrage. The capital gains, if you invest in gold bonds, the capital gains tax is nil. As compared to investing in fixed income, you end up paying your marginal rate of taxation.
Absolutely.
So that, I think, is a great feature of the sovereign gold bond, and I would recommend investors to have at least 10% of their portfolio in gold.
Until now, whatever we've discussed, Ashish, are our views, but when you meet clients, is there anything else in terms of client expectations on the ground, of the market, or rather from the market? What are you hearing from the clients on the ground? What do they want?
See, it's very natural, given the way the equity markets have performed. It's very natural for clients to be euphoric about the markets, because whatever they have invested in the last 1 year, 2 years, 3 years is given phenomenal returns. And as the market and as some of the stocks and funds continue to do well, there is a element of complacency which kind of sets in. there's a belief that past returns are good, so the future will also be good. So there is a tendency to take in more risk. I think this is probably the time when one should be cautious. Number one. Number two, this is the best time to do a portfolio rebalancing. Portfolios should be rebalanced periodically.
Right.
And especially when you see the kind of growth you've seen in one asset class, that is the time when you should be rebalancing your portfolio. And this is also the time where excessive risk should be avoided, especially when you're coming on the back of the fantastic returns being posted by equity funds.
So it was great hearing your insights, and that's it from us, all the viewers. I hope you find these insights useful. We'll sign off for now. Thank you so much for joining us. Thank you.